This conference will now be recorded.
Okay, good morning everybody and welcome to this webinar. I make that just after 9:30. There will be a few more people just joining us as we come along, and I'm sure they can catch up with where we are. We're not going to miss too much right at the very beginning. This morning, this session is being recorded and will appear on our YouTube channel later on today. If you've missed any of our previous webinars, they're all available on the YouTube channel. You just need to go to YouTube, search for Harts Limited, with limited spelt in full, and you'll be able to see all of the previous webinars on various topics since we started this series of seminars back in March last year. Hasn't time flown by? And we've now got this roadmap out of lockdown, and it'll be interesting to see where that goes. We also try to make these sessions as interactive as possible, and to get us all going and making use of the chat box, which you'll see a speech bubble in the right hand corner of your screen. I'm very interested to know how you think the way of working will change going forward. We started this conversation on LinkedIn and last night, and we've already had quite a few replies. But what we're interested in is whether you see your teams coming back into the office, or whether they will continue to work from home, or whether you see a hybrid version happening where you might be working 2 or 3 days a week at home, 2 or 3 days a week in the office. So for the next few seconds, if you could just stick into the chat box, either hybrid, home or office, we can get your views on the way things are going. And that'll be very interesting to see how things are actually going to be working going forward. So if you could just stick in hybrid, home or office, we can get the views of everybody here. And if you want to join the chat on LinkedIn, please feel free to have a look at that and see where you think it's going to go. So far, we have quite a few on hybrids coming through, and some saying more home than office. We've got only the odd one for office. So I can just see that's the way it's actually going to be going. It looks like it's hybrid. I tend to agree with you. I tend to think it's going to be more hybrid than anything else at all. So let's see what actually happens when we actually go forward with this and see where we actually get to. As with all of our sessions, we have to read out this disclaimer first of all. So the following presentation is produced for general guidance only, and professional advice should always be sought before any transaction is undertaken. Individual circumstances can vary, and therefore no responsibility can be accepted by Harts Limited or any of their affiliates for any action taken or any decision made to refrain from action by attendees of this presentation. A couple of housekeeping things first of all. What I'd like to do is mute you all so we can stop any background noise coming through. If you've got anything you want to ask, then please feel free just to use the chat box to stick a question in there. Or if you're feeling brave, unmute yourself and ask a question. Today's presenters are Mr. Tom Bamber from 2XL Commercial Finance and Mr. Stephen Gomes from Amiga Finance, and more on them in a couple of minutes' time. What I'd first like to do is just talk about, we have a free ebook available from our website, and this is on strategic planning. So if you go to our website at harts-ltd.com, just scroll down the page and you'll just need to pop in your email address and you can download our free ebook on strategic planning. We have a webinar on that in about a month's time as well, and we can explain why strategic planning is so vital for your business. So book your place on that as well. Go to our website, have a look on the events page, and you'll be able to book on for that session as well. And also, we'd love you to subscribe to our YouTube channel, because then you're notified of any new videos which may appear later on. We've got some new filming we're going to be doing next month and the month after. So these are going to be short, few-minute videos which may well appear on our YouTube channel. So rather than us having to tell you they're there, you'll be notified straight away. So if you just go to YouTube, search for Harts Limited, with limited spelt in full, just click on subscribe, and all those videos are all there for free, and all the previous webinars are there as well. Moving quickly on, just a quick government support update. We mentioned these a few weeks ago on our last webinar. They are still available, local authority grants, but it all depends on which local authority you belong to. And what you'll need to do is go along to their website, have a look what's on there and see what specific extra government support there is available to you. So if you need any further support, go along there and see what's there for you. These grants open and close at various times. It all depends on how much money they have available and how quickly it gets used up. And it's pretty much first come, first served. So please feel free to go and have a look at that. The self-assessment time to pay arrangements are still available. So if you have deferred amounts from July last year and you haven't paid your January bill yet, then you can still arrange to pay this over 12 installments. They will charge you interest, but they won't charge you the late payment surcharge of 5% as long as you have a time to pay arrangement in place within the next month or so. So have a look at that as well. And the deferred VAT payment scheme, and I know Steve Gomes is going to be touching on this as well later on, but the deferred VAT payment, if you deferred any of your VAT payments from last year when you had the opportunity to do so, the ability to repay that in installments is now open. It opens as from today. And we've got a few details on this. So if you deferred your VAT payments between March and June last year, you have the option to pay the deferred VAT in full by the end of March this year, or you can opt into the new payment scheme by the 21st of June this year. So the instalment options available to you. If you join by the 19th of March, you can pay in 11 instalments. 21st of April, you've then got to pay by 10 instalments, 19th of May by 9 instalments, and the 21st of June by 8 instalments. To join, you've got to create your own government gateway. You've got to make sure that you've got all outstanding VAT returns from the last 4 years, otherwise they're all submitted. Otherwise, you'll not be able to join the scheme. Hopefully, you've all done that anyway. And you just need to make sure how much you own, how much you've deferred, and you can correct errors on previous VAT returns as well. Now, yet again, they've cut out the agents. We can't do this for you. You have to do it yourself. So you need to be up to date with your returns and do it by the 21st of June and pay the first instalment when you join. You've also got to pay by direct debit. But if you want to use a scheme but cannot pay by direct debit, there is an alternative use. So those are the basic rules on the VAT deferral scheme. That opens today, and there is a link on the government website for today, from today. Okay, that's our quick government support update. We're now going to look at the current state of the lending market, and we have two guest speakers this morning. We have Mr. Tom Bamber from 2XL Commercial Finance. Tom works with business owners and property investors to offer advice and support for all commercial financial needs. He joined 2XL Commercial Finance in 2019 to focus on clients across the north of England and is now based in Cheshire. With combined corporate and commercial banking experience, firstly at Barclays and then at Santander, Tom has undertaken a variety of complex relationship management and leverage financial roles. And having worked in financial services for 10 years, Tom has negotiated an extensive portfolio of successful deals, both on behalf of the banks above and more recently for his 2XL clients. And Steve Gomes is the owner of Amiga Finance Limited, which is a commercial finance broker based in Cheadle-Hulme in Stockport. Steve has been in financial services for 20 years, starting in insurance before moving to commercial funding with a private equity-owned finance company. And since 2017 as owner of Amiga Finance, providing access to funding for UK businesses. So first of all, I'm going to make Tom the presenter, and he's going to start with his presentation. So over to you, Tom, if you want to unmute yourself and put your presentation on screen.
Good morning, everyone. Let me just share my screen so you can see the presentation. Can we see that, Stephen?
Yeah, that's fine.
Okay, perfect. So Yeah, thanks for having me on here this morning, Stephen. It's great to speak to you all. I guess first off, this is quite a small group, so genuinely, if you have any questions as we go through, just pop up on the chat function and ask me away. Don't wait until the end. If you've got something you want to query, then just shout up. So I've been asked to speak this morning specifically about the commercial property market. And I think, carrying on with the positivity of Boris's announcements last night, first, just to emphasise, the commercial property market is still open. Clearly, it's got its challenges, as every sector has at the moment, but we are still writing business and supporting clients, and we have done throughout the last 12 months, which is really promising and reassuring. So just a little bit about who 2XL is first. So we are a specialist commercial finance brokerage set up in 2007 by Tom Bamber and Darren Willoughby. We're on all of the high street lender panels, so the Barclays and Santanders of this world as my old employers, as well as NatWest, HSBC, TSB, etc. And then we're on the panel of all of the second and third tier lenders as well. Generally speaking, we're able to cover a full spectrum of risk, and can place that via about the 65 lenders that we're on the panel of. In the last 3 years, we've advised on just over 100 million of facilities, and last year arranged 36 million for our clients, which we felt was a pretty good performance given the backdrop of coronavirus. I'm one of 7 directors spread across the UK. We're FCA directly authorised, and we do have our own internal compliance function, and we're a long-standing member of the National Association of Commercial Finance Brokers. As Stephen touched on, I joined in October 19, so I've worked in corporate commercial banking previously. I decided I wanted to do something a little bit more entrepreneurial. I've got a network of banking and property professionals to support clients depending on the type of transaction that I'm looking at, and in particular I've got strong working knowledge of portfolio and development lending. I live in Knutsford, so I'm based from here, but I do have clients all over around the UK. So briefly on 2XL and our areas of expertise, we look at limited company borrowing, be that working capital, business loans for growth, etc., commercial mortgages. That's probably one of our core disciplines, if you like, and I'll come on to that more so in a second. Investment and portfolio lending, so residential properties, HMOs, mixed use properties, and then commercial. Development funding, and that can be anything from ground up. Renovations and refurbishments, bridging and short-term lending, and then SAS and SIP pension funds. So that's probably a part of the market that is sometimes overlooked. The high street banks won't advertise that they will lend to SIP and SASs, but if you know the right people to talk to, then it is possible to obtain funding for those types of structures. And then finally, management buyouts and buy-ins. So particularly given my previous experience, I can look at funding to support those types of requests. And then more specifically on the property market, which is what I've been asked to talk to you about this morning. So it's a really varied picture at the moment. With the high street lenders, we're seeing very inconsistent levels of appetite. It can be quite difficult to second guess which lenders will support which types of funding requests. That can make life a bit tricky at the moment. And I think it's fair to say that some of the high street banks have probably retrenched more so than others. Some have tried to stay open for business, but it is it's a pretty varied picture at the moment. The majority of the specialist lenders, so what I mean by that is the challenger banks, so people like Shawbrook and Aldermore, and a whole range of others that will go up the risk curve, have remained open for business throughout, with a couple of exceptions. There's particularly strong appetite at the moment for what people call beds and sheds. People love buzzwords in this market, and that is predominantly residential properties and warehousing and logistic type properties. They've both been quite protected in the last 12 months and proven resilient parts of the market to lend to. There are sectors that are quite distressed and where it is more difficult to obtain funding at the moment. The clear and obvious ones being retail and hospitality and leisure. That said, I have arranged funding in the last 12 months for retailers and hospitality and leisure clients, and that's not CBILS funding, that is on standard commercial terms. Commercial property loan to values from lenders have been generally reduced across the board. They're wanting to take a more conservative position, where they might have looked at 70% previously, they might now be looking at 65, for instance, which will mean you do need a slightly larger deposit for those types of property transactions. Residential market values are pretty buoyant at the moment for buy-to-let landlords. Clearly the stamp duty holiday has helped enormously in that market. And likewise with development funding, when I've been looking at schemes where the developer estimated market values pre-COVID, they've stood up to diligence in the current market, which is quite reassuring. Something that is a bit more unknown at the moment, business insolvency rates, they appear stable, but that's probably a bit of a red herring, and we do expect those to increase dramatically when the government support schemes come to an end, and that in turn is expected to impact commercial landlords. So we're probably not quite seeing the true picture there at the moment. So then specifically what I wanted to talk about was three core commercial property products, if you like. The first one being commercial mortgages. So these are loans that are provided in an owner-occupier situation. So it's where a business wants to buy premises that will be used for business purposes. There's a clear benefit to the shareholders of buying an asset, as well as removing the obvious constraints of renting and the costs associated with renting. Owner-occupied commercial mortgages are available on all types of assets. So that could be offices, warehouses, shops, industrial, leisure, healthcare, professional type premises. Generally speaking, if a business can operate from there, then a mortgage can be arranged. There can be fixed and variable rates available, and that could be anything from 2.4 to 2.5% upwards. Repayment terms up to 25 years, although generally speaking, the right advice usually is if a business can afford to pay a mortgage down in 15 or 20 years, that's probably a more preferable situation. Capital and interest can be agreed, so repayment over a straight line or interest only repayment profiles are also accessible. Deposits, generally speaking, from 20%, but it's very sector dependent. So that you could be looking in some circumstances at a 45–50% deposit, dependent on what that subsector is and what the strength of the business is like. Then buy-to-let and investment mortgages. So these are loans specifically designed for landlords who want to rent out properties. Can cover a range of property types, including residential, mixed use. So the most obvious example of that is where you'll have blocks of flats above ground floor commercial, could be a shop, could be a restaurant, commercial properties across the board, or HMO and student type accommodation. The loans can be available as a single property secured against a single loan, or as a portfolio loan where you could have multiple properties secured against a single loan. Options are available for both first-time investors and professional investors. There's sometimes a misconception that you need to be a professional investor to have buy-to-let mortgages. That's not the case. There's lots of mortgages available for people that have, say, 3 or less properties, or where they're looking to buy their first investment property. Rates are very varied in this sector. I've organised funding for limited company borrowers in the last 12 months at 2.25%. Likewise, it's not uncommon if it's interest only and a high LTV on a commercial property, to see rates north of 6% per annum. For residential properties, you can achieve terms of up to 30 years. It's usually less for commercial properties. Deposits anywhere from 20%. And the way they will assess this type of product is they will look at the amount of rental income to cover the loan payments. And generally speaking, the minimum standard for that would be, if it was assessed on a 5% interest rate, you'd want 125% cover of your rental income to your loan service cost. And then finally, development and refurbishment finance. So this is a type of funding used to finance construction or conversion of buildings. It's a specific type of finance for that project. So once a project's been completed, the loan is usually repaid either via the sale of the property or refinance onto term debt. Can be available in residential settings or for commercial projects. With commercial, speculative commercial development is quite tricky. Lenders generally want to see pre-let projects, and the funding can be available to support the exit, i.e. the sales and marketing phase, as well as the build phase. And it is possible to use the same lender in both settings. Minimum loans can be from 50,000 with no real defined maximum. You can clearly get quite large development finance projects. Terms 12 to 24 months, but longer by exception. Real widespread of rates in this market. So you can get high street lenders that will do residential development projects at circa 5% above base, but then it's not uncommon, depending on the experience of the developer and the type of scheme, to see rates in excess of 1% per month as well, so 15+% per annum. And the way these are normally assessed is on two key criteria. So the amount of loan required versus the total cost of the project, and that can generally go up to about 90%, and the amount of loan required versus the development value, and 70% is usually the top end for that type of project. And then just a couple of case studies to bring things to life before I answer any questions if anyone's got any. Firstly, with a commercial mortgage. So these are all scenarios that I've dealt with in the last 12 months. So had an oil and gas consultancy business that was referred to me. They were paying £91,000 per annum of rent on their head office. Because of COVID and the fact that a lot of their consultants were working from home, they had a strategic review of their cost base and decided that they needed a smaller, more purpose, a smaller office that would better serve the purposes of the business. They did have existing debt to factor into affordability, so they had taken a CBILS or a CBILS, as some people call them, loans from a high street bank, and they did have invoice discounting with a separate lender as well. So there was some security and affordability considerations. What I did with that was I sent that out to 8 lenders. It's a strong business and I felt there would be strong appetite, and we got 6 sets of indicative terms. So we were able to cherry pick the best rate and overall terms. We agreed a loan with Barclays at 296,000 for 15 years. It was at a rate of 2.5% above base rate, and there's clear profit and loss benefits for this transaction. You were paying 25,000 per annum, of loan payments versus 91,000 of rent cost. So a clear benefit in undertaking that purchase. Let Refinance, this is a fairly common scenario and one that I looked at last May. So I had a client with 12 buy-to-let properties, all in Staffordshire, mid-terrace type properties, 85,000 per individual property. He had a loan with Lloyds secured against a number of them, 330,000 outstanding, and he wanted to raise just over 300,000 to put as a director's loan into a development project. So the request there, if you like, was to try and extract the maximum value out of those 12 buy-to-let properties. So I engaged with the challenger banks that would generally go to higher loan to values, and we agreed a 675,000 loan which equated to 70% loan to value. That was agreed at a rate of 4.1 over base, 5 years interest only, followed by 20 years on a capital repayment structure. And probably the most pleasing thing with that deal is it was done, as I say, it was started last May and done remotely in lockdown. So the lender agreed to fund 65% using automated valuations, and then when the surveyor was able to go out later in the year, they released another 5% to the borrower. So my client was, very, very pleased with that result. And then finally, development finance. So this is one of my clients based up in Clitheroe. He is doing a 25-unit scheme on the site of a former mill, 7 townhouses and 18 apartments. The total development value is just less than 4.5 million. We agreed 700,000 with a high street lender to support phase 1, and that loan was agreed at 5.2 over base, which is comparatively cheap for development funding. Unfortunately, over the course of the winter months, it became apparent that the bank there, who shall remain nameless, was very reluctant to then consider any phase 2 funding ahead of schedule, which was disappointing, but that probably shows where some high street banks are at the moment. So with that, I went back out to market, and I've been able to agree a 2.1 million CBILS facility with a specialist property lender. Now, that developer has been negatively impacted by COVID. Ultimately, it's the lender's discretion whether they feel it can work under CBILS, but in that scenario, they felt it fitted within, I guess, the sort of ethos and spirit of the scheme. The client was absolutely delighted. He's now got phase 2 funding, and he's able to refinance phase 1 as a bridge while he sells the properties. Under CBILS, there's no interest to pay for 12 months. The arrangement fee is covered by the British Business Bank, and there's no exit fees, which equated to a saving of about £180,000 if you compared that CBILS loan to the funding structure. So my client Rob there was extremely happy. So that's a bit of a whistle-stop tour of commercial property funding, and probably the 3 core areas being commercial mortgages, buy-to-let investments, and development finance. In summary, the market is open. I've been extremely busy over the last 12 months, which is great. It can be tricky to place business at the moment, but with a good broker, the market is still open, and you can navigate it. Happy to answer any questions.
Thanks very much indeed, Tom. That was extremely useful. If anybody's got any questions they want to ask, just unmute yourself and feel free to ask any questions or put something in the chat box. Anybody got any questions for Tom? No? Okay. What I'm going to do next is hand over to Stephen Gomes from Amiga Finance, and I will just make him his presenter. So, okay, Steve, you're now presenter. If you want to share your screen and unmute yourself, and we can hear about your update on the various loans available.
Okay, how's that looking?
That looks great.
Wonderful. Okay, Steve, thanks. Tom, thanks for that on the commercial side of things. Ladies and gentlemen, let's have a look at what Amiga Finance is going to talk about today. But before we do that, to touch on what Steve said, Amiga Finance is a commercial finance brokerage. We were set up 4 years ago and have offices based in Cheadle-Hulme. And last year, we broke through the 10 million in funding raised, supporting clients across the UK, locally, regionally, and nationally. And we've done this by having a panel of over 70 funders, and as you can see there, a broad range of products that we can use to assist businesses, and having access to a good panel of funders means that we can tap into the tier 1 funders, your high street banks, your high net worth funding lines, and we can go across that range for those businesses that aren't quite as financially secure or stable at the moment, which isn't surprising. We have tier 2 and 3 access as well. And as was quite rightly pointed out by Tom, being a member of the National Association of Commercial Finance Brokers is something that certainly as business owners, when engaging with a broker, I would highly recommend you look out for. It's a good badge to be aware of. So why have I decided to focus on BBL, which is bounce back loans, or CBILS, which is the coronavirus business interruption loan scheme? We'll keep it to the shortened versions, and VAT funding. Well, these are timely conversations to be having with fellow directors, with clients, and with business owning peers. The bounce back loan and the CBILS side of things is set to run out on the 31st of March. This appears to be a definitive date, by the way. Funders are working to this now, although this has previously been extended at the end of September and November and January. But I would suggest for now, unless you hear otherwise, that March is going to be the final deadline on this. And the reason we're talking about the VAT, the deferred VAT, as Steve mentioned earlier on, is that anything that was deferred in 2020 now becomes due. So, bounce back loans, quick overview. This funding is aimed at businesses that are the S of SME, if you like, those with under a 200 grand turnover, because funding's available up to £50,000. You can only get one bounce back loan per business. At that point in time of the original applications, what you asked for was all you could get, although this can now be topped up if new financial figures are available. And as you can see, the majority of the funding for this was provided by those traditional high street banks. Rates were fixed at 2.5% over the 6 years, and that 6 years was made up of a year off, no repayments, and the government covering the interest, and 5 years of repayments. We'll see in a few slides' time just how popular this funding has been, mainly because the application process was simple and there were no financials required. As I'm sure you'll have heard in the news, this has led to some potentially fraudulent applications being put in. I think the bulk of the applications have been legitimate, which is good. And on the 8th of February, so a couple of weeks ago, the government announced greater flexibility in the repayment side of this, which I'll summary when we have a look at the figures in a bit. CBILS, the other side of the government-backed funding, this covers anything from 50,000 where bounce back loans stop, up to 5 million, where there is another scheme which is called CBILS, which is for large companies, generally those publicly listed or with turnover, I think, of over 40 million. Unlike bounce back loans, rates are based on underwriting criteria, and this is applied by the funders. And whilst, as you can see there, it says rates start from 1.9% APR, which sounds like a phenomenal offer. Sometimes there's a little bit of marketing that goes into play, because that rate is actually for a 2-year repayment, although I think most businesses that were looking for government-backed funding would probably want the 5 or the 6 year option. And they go up to 14.9% APR. The good thing about CBILS is that businesses can access multiple CBILS funding up to a total of 25% of the business's turnover, or double the annual wage bill. If it's a new company, there's a slight tweak on that, and it can be an estimate of the first 2 years' wages that can be used to come up with a figure. Funders continue, and have done from day one, to vary their offering and their qualifying criteria. And so I suppose at this point, again, it's one of those questions that should I approach the funder directly, or should I engage with an intermediary? Naturally, you'd expect, as the owner of Amiga Finance, for me to say that, but with the amount of funders that are in the marketplace, being aware of who's doing what at what point in time is key. And unless you're going to spend a lot of time researching this yourself, engaging with a good finance broker is a good decision to make. You're not necessarily going to be guaranteed the full 25% of your turnover. So if you, for example, turn over £10 million, it doesn't mean you can have £2.5 million. It means you can have up to £2.5 million. But again, financial accounts, management information, bank statements, all of that information will be taken on by the funders, and a decision will be made as to where they think your affordability as a business sits. We regularly hear funding figures, and in fairness, how generous Rishi Sunak has been. Indeed, as you can see there, the funding that's been provided has been unprecedented. And as we're about to see, BBL and CBILS does take a good chunk of that. Let's have a look at bounce back loans. Hopefully you can see the figures there. As mentioned earlier, the simplicity of application is probably the reason for the large number of bounce back loans, even though CBILS may have been a better fit for some businesses. I mentioned earlier, or you saw earlier, the Chancellor's pay-as-you-grow repayment flexibilities for the bounce back loan scheme, and this includes an option to delay all repayments for a further 6 months, which means that you can have made no repayments on a bounce back loan for 18 months after you took out the loan, the 12 months that you were given as a grace, and now this extra 6. And another pay-as-you-grow improvement is it'll enable businesses to extend the length of their loans from 6 years out to 10 years. This is going to reduce monthly payments almost in half. And you can also, to add more to it, make interest-only payments for 6 months. And this option can be used 3 times during the term of the loan. The question is, does his generosity know no bounds? We'll find out in the spring statement, I'm sure. If we look at CBILS, these figures aren't insignificant, but they are overshadowed by bounce back loans. And as I mentioned, the reason for this lower volume could be the quality of the financial presentations put into the funders, could be the lack of understanding of what the funders required, which does happen when people go direct. Or it may be that £50,000, the bounce back loan limit, was sufficient. However, what we're now seeing is larger businesses are upgrading their accessing CBILS, repaying the bounce back loan, which is a term of a CBILS funding, and accessing more finance. The suggestion would be, if that is a position that you or your clients or your peers are in, then certainly look at this before that deadline at the end of March. A small sample of who we've helped on the CBILS, bounce back loan and CBILS. As you can see there, a much higher average loan size than the 50,000, which may be why now those businesses are looking to repay the 50,000 and take out an extra chunk of money in a time where the rates of and the terms have never been better. That's bounce back and CBILS loans, and we'll answer any questions as we go. VAT, what's VAT? We all know what VAT is. The deferred VAT, Steve touched on this before. In 2020, the government took one of its first support steps by allowing businesses to defer their VAT payment until March this year. And roughly 40% of businesses opted to do that. As you can see there, £28.2 billion in VAT was deferred. It's a massive amount. And as March 2021 is now around the corner, businesses need to be thinking about how they're going to deal with this additional bill, as well as the VAT quarter that they've potentially got coming up, as would be normal. And to follow up again on what Steve covered right at the start of the webinar, thankfully, there is further support available with this VAT deferral scheme. The scheme's open, as was mentioned, from today, and again, it enables VAT to be repaid over up to 11 months, and the scheme is interest-free. This is an opportunity that should be grasped if there is still deferred VAT to be paid. It's unprecedented. I know that is a word that sometimes gets overused, but it would be my strong suggestion to any business owner that they look at utilising this, and to get the maximum benefit from it, to try and make the first application before the 19th of March so that you get the length of the full 11 months. To reiterate what Steve said, if you do apply before the 19th of March, you'll get 11 payments. If you miss that date, you'll get 10 payments if you act before the 21st of April. It's 9 if you act before the 19th of May. And if you leave it all the way till June before you make a decision, and the 21st of June is the cut-off date, and that'll allow you to have 8 repayments. Again, even if you leave it that length of time, it's still better than most options available. However, if for some reason a business misses the dates or is unable to qualify for the deferred scheme, and there are certain criteria that were on the last screen that can be discussed, then there is outside external VAT funding that can be provided, and the key features of that are shown on screen. Again, as you can see, funders are happy to provide across multiple markets. They're happy to provide a range of sectors, and as you can see there, again, it's not an insignificant value for the amount of finance that is being funded. We're pleased to have played our part in sourcing finance and assisting cash flow over the last 12 months. And again, on screen are a few details of another happy client. So that's Amiga Finance. That hopefully covers off some of the stuff that you might have known and forgotten or weren't aware of regarding CBILS and bounce back loans and the VAT deferral scheme. Steve, I'll pass back to you.
Thank you very much indeed. That was a very useful update on the CBILS and the bounce back loan schemes. I'm sure everybody found that useful, and also the update on the VAT funding as well. I hope you've all found that extremely useful. What I'd just like you to be aware of is that we have our next webinars. The budget is actually next week on the 3rd of March. And we'll be running our webinar on the 9th of March. The reason why we've left it a couple of days afterwards is it tends to be that a lot of the detail falls out 2 or 3 days later. So rather than having one straight after the budget, let's wait and see what actually comes out, because always the devil is in the detail. And then on the 23rd of March, we're going to be having a session on why having a strategic plan is so important to you and your business, and a reminder that our ebook is available on this subject, downloadable from our website. Just pop in your email address. It just remains for me to say thank you very much indeed to Tom Bamber and to Steve Gomes for joining us this morning and giving that very useful update. If anybody's got any questions, nothing has come through so far in the chat box. If anyone's got any questions, please feel free to unmute yourself and shout out. Quite happy to take any questions that might arise, but so far nothing has come through. And also, whilst you're thinking of any questions, if there's any topics you'd like us to cover, then just drop that in the chat box as well, or drop me an email at elisha@harts-ltd.com and we'll arrange something for you. So no questions have come through. So thank you very much indeed for joining us this morning. I hope you've all found that very useful. A copy of this recording will appear on the YouTube channel later today, and have a great rest of the day and week. Thank you.